So you've got inheritance tax to pay and you want to avoid it? Well, one of the ways that you could do that is make a gift. A second way is to use a trust. Check out this video for more details. Hi everyone, my name is Simon Mishevich from Optimised Accountants, and I want to talk about inheritance tax. So this is the tax that you pay when you die, basically. The URL is in the video shot here, so make sure you pause the video and get the full report. I want to talk about inheritance tax from a very top level, but before I do, there's the two QR codes. So if you need some property tax advice, make sure you use a QR code, or indeed if you're looking for a mortgage broker, then make sure you use that QR code as well. The links are in the description box below, so feel free to use either of those. Back to UK inheritance tax. So we want to be talking about £400,000 worth of IHT potential to zero and how you do that. Well, we need to think about what is subject to inheritance tax, of course. And if you have got cash and savings, including ISAs, that will be subject to UK inheritance tax. If you have property or related items, such as real estate, property residential or commercial, all subject to inheritance tax. Luxury items such as art, jewellery, cars, whatever you can think of, if it's hanging out there and it's got great value, then you will be paying inheritance tax. There are a few items that are not subject to inheritance tax, and those being pensions. If you have a trade business or agricultural activities, some of that may not be subject to inheritance tax, but you do need to make sure you get some very good tax advice before you embark upon that. You can make gifts, and that's our focus for point today of making gifts, and then within 7 years or after 7 years, that gift is no longer subject to IHT. We'll talk about that a little later. Let's talk about inheritance tax. So let's go with an example of what is not subject to inheritance tax. So let's say you have properties. Now, if you have properties, including a home, then you will have, as an individual, £325,000 worth of IHT lifetime allowance. So that's the amount of assets that you can give over to loved ones when you pass away and not be subject to inheritance tax. If you have a home above the 325 up to 500,000, then you could get this additional 175,000. Again, do get some very tactical tax advice on that point. Therefore, you can get this total band of £500,000. If you're a couple, then that could be £1 million. If one of the part of the couple passes away, then these bands can be transferred over to the remaining spouse. Let's take example then. So someone has £3 million worth of assets, gross market value, but they have liabilities such as loans, credit cards, mortgages, etc. That reduces that amount of 3 million down to 2 million. So we're looking at net asset value for UK inheritance tax purposes. That £2 million worth of net assets is going to be reduced further by the £1 million, as we described earlier. Pause the video if you need to. And that gives you £1 million worth of assets that will then be subject to UK inheritance tax, which is going to be a lot, because £1 million worth of net asset value after all your exemptions would be subject to £400,000 worth of inheritance tax payable to HMRC, which is substantial. So how do you mitigate that? There are 2 points that we're going to focus on in this video, which is gifts and trusts. So if you want to get more details about gifts and trusts, then you can go through this URL. Please pause the video to get that yourself. Good luck reading that material. We are going to be talking about gifts and what does gifts really mean. So gifts without reservation. So you're passing an asset to a loved one, but you are not saying, I want it back later. If you say that, then the asset was never really given away and it will always be subject to UK inheritance tax. It can't be a loan, so you can't just give an asset and say, well, you owe me for this amount of money. That's not there for a gift, is it? Because it's just a transaction. And some assets are subject to CGT, such as like buy-to-let properties. If you give a buy-to-let property to a relative, son, daughter, or in your close family proximity, then it will be subject to capital gains tax based on the market value versus the property purchase price. So again, before you make any gifts, get some tax advice. Make sure you're not tripping yourself up by trying to avoid inheritance tax, only to face yourself with a huge capital gains tax liability. So this video does not constitute as tax advice because we just don't know about your situation. So you are advised to use this QR code and get that tax advice before you do anything at all. Now, if you make a gift to anyone, we know that if you die within the first 3 years, then if you gift away £100,000 worth of cash or assets, then that would still be subject to inheritance tax, which would be at 40%. But it does get discounted the longer you live after the gift is made, then the percentage of inheritance tax is reduced, as you can see from this screenshot. So as it says there, once you have passed a gift, an asset to a loved one, after 7 years, it would not be subject to any inheritance tax. So gifting is a very effective way of reducing your future inheritance tax. But as we know, we kind of do leave things to the last minute. I'm guilty of that. So maybe that doesn't work for us. If we're thinking, well, actually, I've got a life issue here. I'm not sure I'm going to survive 7 years. What do I do? Well, there are other plans that you need to come into action. And again, getting some tax advice on that would be necessary. I want to talk about trust. So what is a trust, first of all? Well, a trust is a legal documentation that your solicitor will help you with. You can get some tax advice from us, but you will need a solicitor to help you form a trust. And a trust is basically where you're gifting an asset via trust to a beneficiary. A beneficiary cannot be you. Otherwise, that would be called gift with reservation. And again, it would be clawed back. What you can do though, is if you have a child, you're not sure you could trust them, they're too young, you could move it into a trust environment. You are the trustee to safeguard the asset, but the beneficiary remains that child. It's not as though you can benefit from that asset. Only the child can benefit from it. Again, as it says here, there are tax implications of using trust. There could be capital gains tax consequences. So again, get some advice. This is only a very high overview, and the length of this video is still quite long. Let's go through an example then. I want to go a bit more detail of gifting a buy-to-let property as for an example. We have a property at £500,000. It has a mortgage of £200,000. Its net asset value is £300,000. And assuming all IHT bands have been used already, then that asset would be subject to 40% tax, which is £120,000 inheritance tax. Now, one of the things I talked about is, could you gift that asset to safeguard from inheritance tax? Well, yes, you can. But let me tell you now, you've got a capital gains tax. So here again, we've got a property, still the same asset, £500,000, but the original purchase price was £250,000. The gain is £250,000. The CGT is 28% for higher rate taxpayers. It is only 18% for basic rate taxpayers. And this also assumes that the CGT annual allowance of $12,300, which could further reduce this amount, has been utilised by other sale of investments. So this is just a simple view of this. Again, do get some tax advice on this. You could really get this messed up. So with this, you've got £250,000 subject to 28% CGT is £70,000 if you gift away that asset now. Again, if you die within 7 years, a calculation is redone to see if inheritance tax would be more than CGT. You don't pay double, you just pay the higher of the amounts. So again, we're thinking here that you're going to survive for 7 years, but you're gifting this buy-to-let property to your heirs sooner rather than later. By the way, if you're doing this, you do need to think about financing and mortgage arrangements. A mortgage company will not be happy with you if you gift away an asset that you no longer have financial benefits from. So in this case, what we've just described is that you could leave your assets in your possession and you pay £120,000 inheritance tax, or you can gift your assets, survive for 7 years, and you only pay £70,000 for the CGT. Which one would you prefer? The big question really is, do you ever want to, do you need the wealth that that asset is generating for you, rather than thinking about future tax planning? And that really does depend on your situation. A trust, really, it utilises your IHT bands, but you would pay 20% above your lifetime allowance of £325,000. So if you're gifting a property at £400,000 into a trust, you would pay 20% on the 75,000 above the 325. So you do need to, again, get some tax advice on this, but the aim here is that you are maximum but going to be paying 20%. It's possible to avoid paying any tax at all using your inheritance tax lifetime allowance, 0%, instead of paying CGT at 28% or inheritance tax of 40% by keeping the asset in your name. So you mitigate both taxes using a trust. Make that trust now for future tax planning. It also takes care of market inflation as well. So if the asset is given into a trust for the beneficiaries of your children or whoever, if the asset grows in value, you avoid CGT and you avoid inheritance tax on that increased value as the market increases. Let's go through an example then. So you've got £500,000 worth of market value property. It's subject to £200,000 worth of mortgage. The net assets is £300,000. So let's imagine that you have that asset going on. You have a lifetime allowance of £325,000. Now, what I said before is that you may not be able to get away from this from a perspective of a mortgage being transferred over. You can get a mortgage broker to help you with this. Again, the QR code is just there for you. So I'm assuming it's £300,000. So whichever way we're looking at this, the net asset value of the property is £300,000. Okay, that's the real focus point here. The lifetime allowance is £325,000 by gifting this £300,000 net asset value property over into a trust. Therefore, there's no CGT because we're using specific case tax law to mitigate CGT, and we're below our IHT lifetime allowance, so there's no inheritance tax either. So that's zero. So again, you could pay tax on CGT or inheritance tax by keeping it in your own name or by transferring it to a trust and mitigating both capital gains tax and inheritance tax. But again, very, very careful tax planning, please, on this one. This is a highlight video. It tells you what the opportunities are, but there's just no way of being able to say what it means for you specifically. It's just too detailed and it's not possible on this video.